I'm going to give you something very, very practical today. It's one of the most practical things that I have ever come across in 51 years of trading. And yes, I know you look at my picture there and you're like, Barry, you're not even 51 years old. Well, thank you. Don't you love it when I put words in your mouth? But actually, my dad was a stock trader and he started teaching me when I was 8 years old. And I'm actually 59 now. So, a lot of experience under my belt, and I want to pass along some of that experience to you so that hopefully I can shorten your learning curve by you learning from my mistakes. So, of course, today we're talking about trading psychology, simple tips to dramatically improve your trading discipline, remove fear and hesitation, and trade with confidence and consistency. So trading techniques, trading strategies, technical analysis, fundamental analysis, candlesticks, indicators, moving averages, all that stuff is really great and can be used very effectively to come up with a high probability trade situation for you, a consistently profitable trading method. But then and that comes first, by the way, so that always comes first. But there's a lot of great trading strategies out there that some people make money with and some still do not. So what's the difference? Well, a lot of it comes down to the 6 inches in between our ears, or between my ears, I think it's more like 4 inches. So I've got to really work on this, and I've had to work on it for a long time. And I actually did an experiment, and I'm going to be sharing with you the results of this. I did an experiment where I worked with 20 traders individually, one-on-one in my office over the course of 2 years. And these were people who already knew technical analysis and how to trade, but they were still struggling with the psychological aspects of it. And the result of that 2-year experiment is 2 exercises that I'm going to share with you now. So let's jump right into this without any further ado, because our time is limited. A little bit about me. I'm the author of Trend Trading for Dummies, one of the famous Dummy series of books, of course, and received numerous Reader's Choice Awards from Stocks and Commodities magazine. I've helped other people with their books, and I work with major companies. Here's just a few of them. Obviously, they vetted me to train their traders. Dave already covered the legal stuff, so there it is for you again, but we won't belabor this. Now, we know that a minority of people make the majority of money. It's basically Pareto's principle, right? The 80-20 rule, as it's more commonly known. And I just want to let you know that this is not unusual. This is not a unique thing for trading. So a lot of people think, oh gosh, trading's so hard because of the 80-20 rule. Most people lose money. Well, that is correct. But guess what? The Small Business Administration says that, well, the last I heard until yesterday was that about 80% of small businesses go out of business in their first 2 years. Yesterday, I just heard an updated stat that 85% go out of business in their first 18 months. So this is not unique to trading. Don't think that, oh, I can do better by opening my own business. No. So it has to do a lot with, there's so many different factors, but today we're going to focus on our individual psychology. So, we all come into a business like this where the odds are against us and we think, well, we're going to be different than the masses because the masses lose money. The bad news is everyone who comes into the business thinks that they're going to be better or different than the masses. And that is kind of a circular thinking. It puts us into a weird mental position where all of a sudden we're thinking exactly like the masses because we're all thinking we're going to be different, which makes us all the same. So it's kind of a mental conundrum there. But we can use this to our advantage. When I realized this, and this is something, it's not really circular thinking. Some people mistake that as circular thinking. It really, in Chinese philosophy, they have a term for it that's translated basically the iron circle. And the only way to get out of an iron circle pattern of thinking like this is to transcend it. So I forget who it is. There's so many of these quotes that go around attributed to different people, but someone once said that you can't solve a problem thinking the same way that you thought when you're inside the problem. It requires a new type of thinking. And that's exactly the same as trading. Again, trading and mastery, mastery and trading, it's not really different than mastery in anything else. Mastery is mastery. and we have to go through the same process. So I thought about this and I thought, now wait a minute. Okay, so if most people lose money trading and I am a human being, and therefore I'm generally, like most people, we have a herd instinct. Human beings are social beings. We have a herd instinct. We tend to follow the crowd. Nothing wrong with that. Biologically, it has some great advantages. In trading, it has a huge disadvantage, and that's part of what makes trading so challenging, is that it feels unnatural. Well, successful trading feels unnatural because it goes against our herd instinct. And you've got to learn how to handle this. So here's an exercise on how I learned to do that, all right? So what I did was I attended a bunch of live trading chat rooms. And I settled on one or two eventually, but I wanted to be in the chat rooms not where there was a professional trader, but actually where there were just amateurs. Now, being in a chat room with a professional trader has tremendous advantages, but I was looking for something different for my purposes. I wanted to be in one that was just all retail traders, all amateur traders who didn't know what they were doing and they were losing money. It seems counterintuitive, right? This whole thing is counterintuitive. So I'd be in there day after day, week after week, month after month, and I'd listen to what they had to say as charts were moving. And then I'd look at the charts in conjunction with their comments. Now, remember, the masses are wrong most of the time. So what you're hearing in that chat room is the inner dialogue and the behavior of the losers. And I don't mean that in a pejorative sense. I just mean it in a very literal financial sense, people losing money, of which I was one for quite a while. So not pointing any fingers at others, and I'm not pointing back at myself. So I did that for 3 to 6 months. I did it for 6 months. You might want to just do it for 3 if you even want to do this. And again, you're listening to their comments and you're watching their charts in conjunction with their comments. Now, I saw similar patterns rising up over and over and over. And I'll give you an example of one of them. And this was one of the most common. The market would go up and make a new higher high, maybe another higher high, maybe another higher high. And then I'd see people start typing in comments saying, oh, this market is way overbought, can't go up anymore, I'm going short here. Well, they would get filled, the market might go down a little bit, a few pennies, pips, or ticks, and then guess what? You can probably already guess. What do you think happened? Somebody type in. Let's see if we've got any winners here. Who thinks they know what happened right after the person went short? There you go, Nina, Michael, yeah. Bill, exactly, stop filled. Michael continues higher. Nina up. Wayne, higher high. Yep, that's exactly what happened. Lou, market keeps going up. Dean, same as my account. Valerie, many people follow. So yeah, you guys get it, right? You've experienced that. Guess what? I've experienced it too. We all have. This is part of the process of learning, that we all kind of have to go through this. And so, yeah, so you understand, you relate to it from your own experience, right? So then I watch them and the guy'd be like, oh, dang, got stopped out. Oh, well, you know, not every trade's a winner. Nothing's 100%. Oh, it's making another higher high. Well, remember, it was already so-called overbought on the last higher high. Now, as who said that? Wayne? Yeah, Wayne said higher high. Correct. So it made another higher high. Now there's things like the guy's saying, oh, this is way crazy overbought now. There's no way it can go higher. By the way, if I had $1 for every time I heard somebody in a chat room say, this can't go any higher, those are death words right there, right? As soon as someone says it can't go any higher, what's it going to do? It's going to go higher. Yeah. So, of course, then he'd say, this thing is way overbought. And of course, they would back it up with some sort of support resistance levels, Fibonacci, Gann stuff, VWAP, oscillators, moving averages, you know, whatever indicators, technical analysis they were using. They would have a reason. And so they say, oh, I'm going short here. This is almost a sure thing. And sure, the market would go down a little bit. And then guess what? Yep, went up again and stopped the guy out again. And so now he's getting really perturbed. Well, to make a long story short, it would happen the third time. Market make a higher high, he'd go short, and then he'd get stopped out again as the market went even higher. Well, now he's not talking about, you know, terms of technical analysis of moving averages and average true range and all that kind of stuff. Now all of his words, well, we'll just say they all contain 4 letters. He's like, that's it. This market's crazy. I'm going to play golf, or I'm going to the gym or Starbucks or whatever. Okay, so that is one pattern that I saw happening over and over and over and over. Basically, people, what it really is, and I talked to one of my mentors, Ray, about this, and he says, oh, yeah, that's a very common thing for new traders to do. And he says, I call it the kamikaze phenomenon, because it's just suicide. You're stepping in front of a bus. The market's going up, and for some reason, as human beings, we tend to have this thing where we want to do the opposite. And I could resonate with that too, because I was doing that as well. But when I saw it with my own trading, that was one thing. When I saw it from a third kind of a distance, watching other people do it, gave me a different perspective. And then when I watched it happening to them over and over and over, 3, 6 months, pretty soon, I finally got the message through my thick skull, since again, remember, I was doing this mistake, that dang, that is exactly what I don't want to do. That is one of the most common patterns that traders take, these overbought, oversold signals. It's the exact opposite of what you should do. Why? Because you should go with the flow and not try to swim upstream. That's what they're doing. They're trying to swim upstream. That's what I was trying to do. And I had no idea. The reason, all I had to do is turn around. I mean, have you ever felt this way? Somebody type it in for me. Is Dave? No, I haven't changed the this screen yet, so it's not frozen. It's just we're still talking about what's on this screen. And so this is the kind of thing that happens to us over and over and over and over when, and again, type in if you've had this experience where you thought, you know what, my trading is so perfectly imperfect that if all I did was take the opposite side of every one of my signals, man, I'd be wealthy. Have you ever felt like you were that wrong? I have. I mean, everything I'm telling you is stuff I've experienced, so I'm sharing this all from my mistakes to try to help you. And that's what I was learning from these people, right? I was learning from their mistakes. Sometimes it's easier when you can see it, again, being at a distance and watch somebody else doing the same stupid stuff over and over and over and over. And then you say, hey, I do that. So yeah, Nina says, yes, John, happened today. Oh, with IWM. John, what about contrarian trading, overbought, oversold? Yeah, so that's a different thing. That's a great question, John. Contrarian trading. But contrarian trading is not the same as overbought, oversold. Big discussion there, great one. I should probably do like a video and article on that someday. And then Daniel, Mr. Gee, Pamela, a lot of people saying, yep, they have that same experience where it seems like if they just took the other side of their own trades. You know what you can do to make some money is come out with a trading alert service. So yeah, come out with a trading alert service. Every time you got a trade and you're going to go long, just shoot that out to all your subscribers and tell them to go short, and you'll probably clean up. So I'm not serious, but anyway, so that's one thing. And I got to tell you, oh, let me go back here, because what I want to show you is one last thing, even though I've been on this slide for a long time. Yes, this is it right here. So after you do this, the reason you have to do this for a period of time, a lot of repetition, is so that you start to see these patterns over and over and over and over, so they become undeniable. And before long, what you're able to do is the reverse. In other words, what we did at first was we watched we listened to their comments, right? And we watched their charts in conjunction with their comments. Well, after you get so much repetition under your belt, you're going to start to be able to do the opposite. And this is what happens to me now. I can watch a chart and not even be in a chat room. But because I did this for 6 months, almost every single day for 6 months, I've got their self-talk in my brain now. I have that self-talk in my brain, their self-talk. And so I can look at a chart now, and I can tell you exactly what the amateurs are saying and what they're thinking. And that's the advantage. That's the powerful advantage. So that is so powerful, I can't even tell you. Okay, so that's exercise numero uno. By the way, in Market Wizards, great book. If you haven't read it, highly recommend it. Jack Schwager interviews some of the most successful traders in search of what they have in common You know, that's really why he interviewed all those traders. And here's his conclusion at the end of the book. What set all these traders apart? Most of them think, or most people think, that winning in the markets has something to do with finding the secret formula. The truth is that any common denominator among the traders I interviewed had more to do with attitude than approach. Attitude than approach. Again, the psychology of trading. That, my friends, is where your answer is. And I understand this presentation is not the one with all the bells and whistles. It's not the shiny object stuff. I'm not going to be able to provide you with the Holy Grail indicator. Why? Because that's not where your success lies. Your success lies in doing the hard work, the stuff like this that most people won't do. I gave this presentation last year, and I saw someone actually type into the chat box. Nobody's done it today, but I gave this very same exercise. Someone typed in the chat box like, "Yeah, I'm really going to do that," you know, sarcastically. And I just thought, well, good, dude, man. No, I know that most people aren't going to do it, and that's why I make money. And you know, you don't. Not to have an attitude, but I was willing to do what most people are unwilling to do. That's one of my favorite quotes from A.L. Williams. Successful people do what unsuccessful people are unwilling to do. One of my favorite trading books is not even about trading. It's called Money Management for Gamblers. It's by John Patrick. He's a poker player. And there's actually a lot of commonalities between trading and poker. I'm not a poker player myself, but this book was really good. And here's a little quote from it. He says, people who are way better educated than me rip my theories from here to Hades and back. They claim gambling is all math and statistical analysis. Does that sound like maybe what you've heard about trading? It's not all about that. That's part of it. That's part, but it's not all of it. They never grasp the true meaning of gambling because they've never been there. People who think that a math equation is going to give them a leg up on winning ought to have that leg whack them in the area where they sit on their brains. Now, should have told you that John can be a little colorful sometimes. Now, here's the main point, and here's exercise number 2. The pros don't make mistakes. That emphasizes mine. And they don't have tells. Patience is a virtue. Overtrading, by the way, is one of the most biggest cardinal sins in trading. It was my biggest sin. Stupidity is a one-way street to disaster. Talk is minimal. Mercy is absent. Make a mistake, and 7 vultures circle the wagons waiting to divide the spoils. So mistakes is what we've got to solve in trading. If you're not trading well with a successful methodology, most likely you're making mistakes. So is there a way to eliminate them? Well, I won't say eliminate, but dramatically reduce them? Absolutely. And if you don't, you will remain a losing trader. You need to focus on dramatically reducing your mistakes. Now, I've got 10 commandments, which are general rules. These are really the top 10 mistakes that I have found not only myself, but my students making. I've documented them and provided solutions to all of them. So you want to see them? All right, here we go. So there's the first 5. Make sure you don't do any of those. And there's the other 5. Make sure you don't do any of those. And if you avoid those 10 mistakes, you'll be golden. Okay, so moving on. Okay, I'm not going to go over all 10 of those, but I will give them to you. If you just send an email over to barry@topdogtrading.com, just ask for the top 10 mistakes list, and I will get that over to you. Okay, let's see here. Where am I? I'm trying to get to the chat box, typing in my email address. And there we go, barry@topdogtrading.com. Just ask for the top 10 mistakes and we'll send you an email with them for free. Okay, so here's the second exercise. We're going to, and actually I can skip that because here's the main thing. We're going to use a form, a trading log, that's a little different than most trading logs. Because in any trading log, sure, we'll put the entry time, you know, where we got in, where we got out, and all that kind of stuff. That's cool. Here's what we want to do in our trading log. We want to have these sections down here, and this one's the most important. So after you take a trade, this is your daily trading log, so this will be one trade. In the notes section, I write down what I was thinking and what I was feeling. What I was thinking, what I was feeling when I entered the trade, and you can do it when you exit the trade as well. Why do you want to put down those two things, thinking and feeling? Very important you put down both. This is your own biofeedback. This is you getting kind of a third part perspective on your own trading, but you got to see the patterns. You got to see it over time. And pretty soon what happens is you'll see that times when you are, and this will vary from person to person. So this is a gift you have to give yourself because we all think and act differently. So this is why you have to do this for yourself and I have to do this for myself. But after a while, you'll find out that when you, let's say, well, I'll just share one of mine. So one of mine was if I felt, a little uneasy, I'm like, boy, this looks really good on my main time frame, but when I look at the higher time frame, it's not quite confirming, but it's so close and it's a really great setup on the short-term chart. I'm going to take it anyway. Okay, I found out that whenever I was thinking that, 9 times out of 10, I would lose money. And so that's one thing. When I was feeling like, if you feel anxious or confident, notice what the results are when you have those feelings. I can't tell you whether those will be good or bad for you. You have to document that and note the patterns. And then mistakes, here's where we put in any of those top 10 cardinal sins of trading that you might have broken. So this now is different than what you're thinking or feeling. This is where you actually broke your written rules. And my list of 10 there, that's just to get you started because your trading methodology may have some different rules. So the bottom line is have a rule-based method, very objective. And whenever you break one of those rules, you write that in that yellow section. And you're going to start to see. So you write that in here and on each trade, again, trade 2, what you're thinking, feeling, trade 3, mistakes. Trade 3, I'm sorry, down here, and then mistakes. Okay, now, then the magic is we take that over to a weekly log. And on the weekly log, we transfer all that stuff. So here's day 1, day 2, day 3, day 4, day 5. And then we summarize them. How many winners did I have? How many losses? What was my total profit? My total loss. My average win, my average loss, dollar-wise. My commission, total commission for the day. After commission, slippage, all that stuff, what's my net P&L here? And then what's the percentage of my account I increased or decreased that day? Now we get to the mistakes. How many mistakes did I make in the total day? All right, I'm going to skip a column first. Then here I write down the mistakes and I'll say, again, we're going to summarize them. So let's say I got in too late. All right, well, that day, how many times did I get in too late? So if I got in too late 5 times, I'll just put in got in too late and put the number 5 to it. Okay. And maybe chased the market or got out too early, only did that once. Okay, good. Well, then this column comes in. So then I say, okay, let me take the net profit or loss and subtract all the trades where I made mistakes. If I didn't take the trades listed on my daily log where I made mistakes, then what would have been my profit and loss for that day? And that over the course of a week, and especially over the course of a month, you're going to see a big difference. So there's 2 things here that we're going to do. Number 1, on mistakes, we're going to look for the most dominant patterns of the mistakes you make. My number 1 was over trading, getting too aggressive with trades, not waiting, didn't have the patience for everything to set up and confirm as well as I should have. So I would kind of, fudge, that's the word, I guess, fudge my rules a little bit when I thought things looked good. And that was another phrase I wrote down here a lot. What was I thinking? I was thinking, well, this looks good. Man, I learned after that feedback, and then what you do is you listen to your brain right before you're about to take a trade. What am I thinking and feeling? Oh, this looks good. Whoa, wait a minute, put on the brakes. I know from my logs that almost every time I think this looks good, it doesn't work out good. And so just for that reason alone, I wouldn't take the trade. That's the kind of results you get. Sure enough, most of the time I would lose. So here we look for patterns. So again, my number 1 was over trading. For you, it might be cutting your losses too soon if you do that a lot. So don't worry about the ones where you only make, like out of a week, you only make that mistake once or twice. But if you're making it 10 or 20 times, oh my gosh, then yeah, that's the one you need to work on, right? Work on 1 or 2 at a time. Focus on 1 or 2. And then here's the magic to change the behavior. Because psychology books on trading are great, right? There's a lot of really good ones out there, but just reading words in cutesy quotes is not going to change your behavioral finance. To change your behavioral finance, you need to change behavior. And that's what this is doing. That's what these exercises are doing. These exercises are behavior you're doing, and they act as a mirror to your internal trading psychology. This is not a piece of paper. This is a mirror. And now what's going to happen, where it gets motivating, is when you say, oh, dang, this day I lost $500, but if I wouldn't have made these mistakes, I would have made 1,000. In this day, I lost 100, but if I didn't make any mistakes, I would have made 1,200, whatever the numbers are. And you compare that column, your actual profit and loss, versus your profit and loss without mistakes. And I got to tell you, people I've done this with face-to-face, 9 times out of 10 of them have found they're already a profitable trader. Already profitable. And it's so cool to do it with them face to face, because I look in their eyes, I see their face, and it's like this look of wow, recognition. It's almost a transformational experience, and exciting, because they're like, dang, here I've been trying all this different stuff and looking for the answer, and the answer is right here. All I have to do is not add stuff. I just need to reduce stuff, and namely my mistakes. So that's it for today. Those are the 2 exercises that I have for you. You could try one or both, or if you want to keep on the road you're on, neither, if you don't find them helpful. But I do want to give you, I don't have anything for sale today. I kind of dropped the ball on that. So all I have is free stuff. So hope you don't mind. But yes, I will be happy to give you one of my courses for free. This is a course on how professionals trade differently than amateurs. 5 videos. And at the end of each video, there is an interactive quiz, so you can test yourself, make sure you got it. But it's not just theory. This course actually gives you one of the most practical things in the world, an actual working trade setup. I call it the rubber band trade. So I'm going to give you that in the course as well. That's in video 4. Gives you all the rules for entries, exits, setups, everything. You don't need any proprietary indicators. So it's a simple trade. I love it. I trade it every day it shows up, which is most days. And then also I'll give you access to my personal cycle indicator. This is through a separate webinar where I help you get the indicator set up in your charts and how to trade it, because like a lot of things in trading, it's actually counterintuitive on how to trade it. So you can get all that for free by just going to one place, and that one place, as you can see, is right there. It is topdogtrading.com/free. And as soon as you go there, you will get an email, and that email will give you information on how to access the course and how to sign up for the personal cycle indicator. Again, all this is free, no charge for any of this. So, wow, made it. Got 1 minute to spare, 1 whole minute. So I think I better just stop there and allow Dave to do the transition here so that we stay on schedule. But if you have any questions, feel free to write me at barry@topdogtrading.com. I also, no, I didn't. Let me type my email in to the chat box and the question box as well. I thought I did that, but I don't think I did. So let's do that right now, barry@topdogtrading.com. Any questions you have, and again, if you want the list of the top 10 trading rules or basically mistakes to start monitoring for yourself, just send me an email and we'll reply and attach that to the email for you.